first, we start off with the market sell-off. Stocks getting slammed today, down more than 300 points at the lows of the session. The market now on track for its worst week of the year. And we are starting to see cracks in the market spreading. Transports now down for the 10th day in a row, the worst losing streak in more than a decade. Small caps are getting smacked, falling deeper into correction territory, and the chips, they're getting crushed. So as many of the things that led us higher are looking like they are breaking down, is it a sign that the worst is still to come? How bad could things get, Tim?
Well, think about how good things were. And I think, this is really a case of we've oversold, overbought, et cetera, repositioning. But look, the market over the last few days is telling you it's very concerned about growth. It's not worried about inflation. It's not worried about trade. It's worried about growth. Look, you have treasuries down at 264 on the 10-year. Look at what's going on with the dollar. The dollar is rallying because the ECB today should also have you concerned. So basically Draghi in there saying we're not doing anything anytime soon. In fact, negative interest rate policy is here to stay, or so it seems. Terrible for European banks, which, by the way, are a systemic risk for the global economy as well. So I look at the dollar up 75 basis points. That's usually a sign of risk off. I look at the 10-year Treasury. We're down to 264. That's telling me, look, at 260, we break through there, I'm worried. And we're at the 200-day on stocks. So, look, for people that have said this was overdone, they were absolutely right that I think, let's wait to see where this settles. I don't think we are going to retest. I don't think we're even going to get close to retesting. I think Friday we're going to be reminded that we have a decent payroll number.
It remains to be seen whether we're going to test or retest. But I agree with Tim. It was all positioning. I think we got way too pessimistic, way too optimistic on the way up. There's zero growth. German PMI is basically at 74-month low. I mean, there's no growth. There's no growth in Europe. Growth is cascading lower here. I do believe we'll test lower levels. I'm not sure if it will be the lowest levels that we've seen.
So Tim just mentioned 264 on the 10-year. You get worried below 260. When you think about late 2016, all of 2017, the narrative was that stocks and bond yields can go up at the same time because the 10-year going back up towards 3%, almost doubled off of its lows in 2000, was bullish, right? Because it's a reflection of kind of this reflation in global growth. Well, now I think it works the other way in a lot of ways because, the stock market is still not a whole heck of a lot from its all-time highs, but there doesn't seem, if you just look at the interest rate expectations, zero increases for the rest of the year here. So this 264 is reflective of the fact that there is no growth, and I just think that what happened with the ECB, we know that Mario Draghi will do whatever it takes. The difference between now and 2012 when he said that is that there are negative.
He's got nothing left to do.
Well, that's the point.
He's got nothing left
what's
to do.
left in the toolbox, so we could have a situation.
I get what you're saying, but when Mario Draghi comes out and basically says negative interest rate policy for the foreseeable future, at least through the end of this year, that puts a weight on our Treasury yield. So should we really interpret the 10-year yield at 264 as an indictment of growth here in the United States when we're really being tethered, right, to what's going on around the world?
I agree. I think that's a different issue going on, right? So I think it really solidifies the Fed absolutely being, not a factor for a long time. That I think is a material event in the market. So as we wait for a trade deal, which is fairly priced in already, right? If we see a hiccup in a trade deal, that's really going to be bad. We're going to see volatility really spike and probably a pretty aggressive sell-off. I think we will see a trade deal, so I don't know that we get there in a straight line. That, to me, is the biggest risk to the market, bigger than some of the other factors, bigger than what data we see on at the end of the week, or tomorrow, I guess it is already. And then we'll start to see some earnings. But I don't think we can really see earnings power accelerate until we have some clarity.
Well, here's the other thing. So you're talking about clarity, right? And you're talking about corporations putting money to work, CapEx. We have not seen a boom that we expected to be unleashed after those tax cuts in late 2017. And, any deal that you get before Q1 earnings next month in April is going to be a deal that the market doesn't want. I'm just telling you. I mean, think about it. That New York Times story that came out today, there was a leg lower when it said that the Chinese maybe not so in such a big rush to do the deal that Donald Trump wants.
It's set up so for a sell the news event. I'm not sure, maybe there'll be a little pop on the day of the news breaking, but I can't imagine it be a long lasting pop. And when you start to talk about the ECB, that they're out of bullets, our Fed only has 250 basis points of bullets. What's that going to do for an economy if the economy slows?
Well, they have balance sheet bullets.
But
balance sheet bullets that they're still doing QT, that they're unwinding. So if
But if you're saying they don't have bullets, they're still, right? That is a lever they could pull. Or a lever, if Brian were here, he would say
you
it was a
need
lever.
500 basis points on average to pull an economy out of recession. You need a vast, strong, softening curve for the yield curve. You need them to throw everything. It's got to be protracted. I don't think there's going to be a protracted and deep dovishness of the Fed. He's got to cut rates, and he's only got 250 basis points to play around.
A lot of responses, but I'll say this: I don't know that 500 basis points is a rule of any kind.
Just historically.
I do think you've got a dynamic here where the Fed, we'd like to see the Fed get to normal, and therefore we're all a little disappointed. And the balance sheet is certainly another place where we've only taken 11% off the balance sheet's peak size. Okay, so there's big issues here. But let's put this in the context of where the economy is right now. I don't care what you say. I don't care what the ECB is telling us. The U.S. economy isn't close to a recession. So if the Fed is very, very easy, if global conditions actually stay very, very accommodative, these were the things we were most worried about 9 months ago, 12 months ago. So, yes, we're late cycle, but, we've reassessed on expectations on a lot of stocks. And, yes, we rallied back hard. So let's not get carried away. I don't think we can test 3,000 on the S&P anytime soon, but I don't think we're testing 20,000.
But everything that you just said, so EPS is flattened or gone negative. Margins have peaked, and GDP went from 4.2 a couple of quarters ago to 2.6. And now with estimates to maybe be below 1%. So I don't disagree with anything you said about the economy, but when you look at the backdrop of the fundamentals, I'm not sure you want to be paying anywhere close to the multiple that we see.
Except for the fact that we've had periods, 2015 for sure, even early 2016, where we were paying an enormous multiple for equities because, in fact, rates were nowhere. The earnings, essentially the earnings premium, the yield premium on equities was much more attractive. On a discount rate, basically, if anything, equities get a lot cheaper when your discount rate goes lower. They're worth more. So I look at the environment, and I think I don't like everything you guys are saying sets up for a nasty, nasty situation somewhere. Fed out of bullets, other central banks deep into negative territory, and global debt in negative yielding territory. But guess what? It's not happening anytime soon. And you get to a place where I think a lot of companies also who put the brakes on capital spending, who put the brakes on any kind of investment, I think are going to get back into the game.
If you're listening, Grasso, at home, and you're listening to what you're saying,
right here.
One would think that you are doom and gloom at this point, that you are negative the markets, because how can you be constructive of the market?
I think you need to recalibrate. I think you really need to readjust where the market is, what you're willing to pay for it, and you're not in a global synchronized softening. You're not in a dovish state anymore.
You're in a global synchronized dovish.
You had an ECB throw an unbelievable amount of aid toward their markets in 2015. And here we are with all of the European markets pretty much where they started in 2015, and they have zero GDP. So all of that easing that was thrown on the marketplace did nothing.
Okay, so we were talking about positioning earlier. Is the positioning on Wall Street such that everybody is negative Europe, and that the outlier situation is actually an upside surprise should China stimulus actually kick in?
Yeah, but here's the problem, right? So I keep hearing this, the third year of a presidential cycle, it's really good for stocks. Okay, well, here we are. It's March 7th, and the stock market's up 10%. Okay, so as far as I'm concerned, I don't really see what the upside is, considering the fact that the likelihood of the most important positive catalyst would be global reflation in growth, right? And that's not going to be something that we're going to start to see green shoots of anytime soon. I know you think that Europe and China might have bottomed. There's no indication anywhere that that's actually been the case, other than the expectation of more fiscal and monetary stimulus. That's it. So I look at what's going on here in the U.S. and I say we're up 10%. I'm looking at the NASDAQ got rejected at 76.45. I'm looking at the S&P 500 got rejected at 2,800. I look at the Russell 2000 down 5% just from its recent highs, and I say to myself, we're probably going to be trading in ranges just like we've done for the last 18 months, but there will not be new highs, and the likelihood is that we do see the S&P back towards 2,500, 2,600 at some point in 2018 or 2000.
Well, let me ask you something. A lot of what you say has absolute merit, right? We've seen some of the data is not supportive of Europe growing, but if we were to get
a lot of it was silly.
a lot of what he was saying was still. Okay. Let me just
I
ask
was
you,
married lots.
in a rate environment like this, with a Fed put and an ECB put and
not a put
around the
anymore.
world
It's
put.
not a put anymore.
Okay, that's my question.
Yeah,
You don't think it's a put
just
anymore?
not. At 10
It has
years,
proven to be a put
10 years
for
into the
a long
cycle. If you
time.
go back and you look at all the iterations of QE and what happened to the market before they came, it was just desperation time. Balance sheets, corporate debt balance sheets, and sovereign balance sheets were in a different place. Things were very fragile. Now I think to where we are in 2019, 10 years on, and I'm saying to ourselves, look at how big these balance sheets of these sovereigns are. What are these bullets that they have to do? We have this $4.5 trillion balance sheet. It was less than $1 trillion when we started QE back in 2008.
Massive
So to me,
deficits, too. I mean, we just had a terrible deficit number, 2 days ago.
Right.
So, look, again, I think we have to think about this in the context of where we are in the markets. You guys are talking about 2 years out. I don't.